All right, folks. Now, our real economic condition reminds me, of a really famous poem by Dylan Thomas. You may know this one. Do not go gentle into that good night. Old age should burn and rage at close of day. Rage, rage against the dying of the light. Though wise men at their end know dark is right, because their words had forked no lighting, they do not go gentle into that good night. You know, I was reminded of that poem when I was reading Jim Grant's work. My next guest, who has been, it's so amazing. Jim,
Careful.
Jim, here's the thing that the line that really made me think of this is when you said inflation is burning like an underground coal fire. It won't go gentle into that good night, even though Wall Street keeps dismissing it and saying it's over.
Well, it might be over, right? This is a world of probabilities. But it seems to me that the more likely case is that inflation is persistent. Why? Because we all seem to want it. We vote for it, Wall Street roots for it, and the government perpetrates it. So we have an election year. Intel gets $8.5 billion or so today to build a chip plant.
Right.
The deficit is going to be between 6 and 8% of GDP when unemployment is less than 4%.
Right.
So it seems to me that inflation is on the agenda. Now, in the 70s, these are not the 70s, make no mistake. In the 70s, inflation surged like that proverbial underground coal fire, 3 separate breakouts. Will it be the same? Nope. But are we quite sure that it's ending?
Right.
And I am not at all sure that it is ending or over. Paul Volcker himself was a little premature when he declared almost as much in the year 1971, when he was at the Treasury Department.
Right. And so, I mean, but it is a central question.
Yes.
It's essential. And you make a great point. Listen, we love inflation when the value of our homes inflate, when our paychecks inflate. We don't like it when milk inflates. We don't like it when gasoline inflates. And it's hard to have one without the other when the government is the one cranking out the money, whether it's the Federal Reserve or the federal or the fiscal policy.
Correct. Yeah. Well, inflation is I think, kind of ubiquitous. For example, we have it on Wall Street. That's the pleasant kind.
Right.
But the Fed is apparently, if I read the tea leaves right, the Fed is projecting 3 rate cuts this year, notwithstanding new highs in the S&P, new tight spreads, junk bonds to treasuries, meaning that speculative grade bond yields are the tightest they have been against treasuries since 2021 or something. And then Bitcoin, I think, is up.
Yeah, a little bit. But I mean, so it's sort of maddening then, right? Because your work, you from what I've read, you actually believe that maybe the Fed, if anything, if they were, textbook without any other influence, instead of anything, it would be a hike this year, not cuts, but potentially a rate hike this year.
The Fed is, I think, has got a guilty conscience. A dozen years or so of 0% interest rates have had consequences. What consequences? Right. Well, a levitation in commercial real estate, excessive leverage in the private equity world, a venture capital out over its skis, endowments at college and university becoming more and more illiquid in the search for yield. So the consequences of these ultra-low rates are now making themselves felt. Right. Francis McDonald and Danielle together made the point that the effect of rising rates is not instantaneous, but can be as long as, 2 years from the inception, which, as Francis said, is today.
I've only got a minute to go. If Powell's going to be stepping up to the podium in a moment. Your call on the secular bear market has been right so far. I mean,
bonds.
Bonds, I'm sorry, the secular bond bear market has been right. This is a relatively long-term chart, and I think, we needed one even longer than this because I think folks don't think about these long secular moves that bonds make, right? I mean, you had a 40-year move higher in yields, then you had a 40-year move lower in yields, and this could just be the beginning. And I refer to your work all the time to folks, particularly Wall Street experts, who seem to say, hey, keep loading up on bonds, even though they're not working.
Right. Well, there's such a thing in finance and investing called muscle memory. I think in sports too.
Yeah.
And 40 years of operant conditioning about falling interest rates, I think, are a pretty powerful influence on people. Certainly there were in 1981 at the peak of yields. People could not remember when they were ever low, and nor now can they ever remember when they were ever high. But they have been, and a prediction, they will be again.
Thank goodness that
Okay.
we have you around to remind us.
Thank you, Charles.
Thanks, Jim. Appreciate it.